Over the past few years, one of the most fascinating shifts in Bitcoin's adoption has come from an unlikely corner of the financial world: corporate treasuries. What started as a bold experiment by MicroStrategy in 2020 has evolved into a broader trend. As of July 2025, it's estimated that between 134 and 145 companies now hold a combined total of around 855,000 Bitcoin. That is roughly 4% of Bitcoin's total supply. At today's prices, that stash is worth over $79.5 billion. And to put that into perspective, MicroStrategy alone holds 597,000 Bitcoin, making up over 70% of all corporate Bitcoin reserves. Clearly, corporate adoption is no longer a fringe idea. For Bitcoin enthusiasts, this development can feel like a win. It's a strong signal that Bitcoin is no longer just a tool for ideological cypherpunks or tech-savvy investors. It's becoming a core component of institutional financial strategy. But if you've been following this channel, not everyone is cheering for this. With corporate adoption comes a set of new dynamics: increased price influence from boardroom decisions, custodial concentration, and the looming possibility of mass sell-offs during bear markets, and I've covered that before. All right, these aren't just abstract risks. They shape the future of Bitcoin ecosystem and the experience of everyday users. So in this video, we are going to take a balanced look at the pros and cons of companies adopting Bitcoin as a reserve asset. We'll break down why this matters, who's doing it, and what the data shows, and what every crypto enthusiast should keep in mind, especially as we move deeper into this new phase of institutional participation. Let's get into this. Okay, there's no question that corporate adoption of Bitcoin comes with serious implications, some encouraging and some way more complicated. Let's start with the upside. First, Bitcoin's legitimacy is strengthening, okay? When major companies start putting Bitcoin on their balance sheet, it sends a powerful signal to markets, regulators, and the public. This isn't just some internet money anymore. It's being treated as a serious strategic asset by some of the most recognizable names in business. And this trend is accelerating. In just a few years, the number of public companies holding Bitcoin has jumped from around 20 in 2022 to over 60, possibly as high as 124, depending on actually how you count it. So the growth has been supported by macro tailwinds like the US Strategic Bitcoin Reserve that was announced in early 2025, and over $43 billion in ETF flows just in Q1 of this year, with BlackRock leading the charge. What this means is greater liquidity, deeper markets, and potentially reduced long-term volatility. The more Bitcoin is embedded in the global financial system, the harder it's going to be to ignore. Okay, so let's go over to number 2. Bitcoin is being used as a hedge and a way to diversify treasuries. We are now 5 years into an era of aggressive monetary expansion. Now, check this out. Since 2020, the US M2 money supply has ballooned over 40%, while inflation has constantly outpaced bond yields. That creates a dilemma for corporations: leave excess cash idle and watch its purchasing power erode, or take a calculated risk on harder assets. Bitcoin, with its fixed 21 million supply, has resistance to inflation and has become an appealing adoption. Okay, so companies like Mercado Libre have used Bitcoin to hedge against their weakening currencies. And in Argentina, the Argentina peso has lost over 50% of its value in 2023 alone. So now let's go over to MicroStrategy. They, of course, are the poster child. In its initial $250 million investment in 2020 has ballooned into an over $55 billion in holdings today. And that's not a balance sheet number. It's become central to the company's identity and market value. Third, there's a real financial upside. MicroStrategy's stock, for example, surged over 350% in 2023, outpacing Bitcoin's own performance, largely because of its aggressive accumulation strategy. Shareholders now view the company as a proxy for Bitcoin exposure, and in bull markets, that has paid off very handsomely. And it's not just about holding coins. Companies with strong credit ratings can issue debt, usually in the form of convertible notes, to buy Bitcoin. So MicroStrategy has done this repeatedly, allowing it to leverage into Bitcoin during favorable market conditions, with an average purchase price of around $70,000 per coin, and today's price roughly sitting around $117,000. The company is sitting on nearly $14 billion in unrealized gains. Okay, now fourth, there's a branding benefit. In a world where innovation matters, not just for product development, but for investor sentiment, holding Bitcoin can be a reputational asset. Companies like GameStop, Rumble announced Bitcoin reserves in 2025, and it was met with enthusiasm, especially from younger crypto-savvy investors who view these moves as a sign of forward thinking. On platforms like X, these announcements trend almost immediately, driving both engagement and price action. In the short term, that can help boost stock prices and visibility, but as we'll discuss later, it also raises concerns if Bitcoin is being used more for marketing than for long-term strategy. Still, the core advantages are real. Bitcoin is proving itself as a legitimate, high-conviction treasury asset. It offers upside diversification and an increasingly respected place in corporate finance. Of course, no trend is one-sided, and corporate adoption has a flip side. As bullish as corporate adoption might seem, it's not without its risks, okay? And in some cases, they're substantial. Bitcoin may be maturing as an asset, but the environment around it is still volatile, politically charged, and operationally fragile. Let's break down the biggest concerns right now. First, there's the issue of volatility. Bitcoin's long-term trajectory has been impressive, but its short-term swings can be absolutely brutal. We've seen 50, even 70% drawdowns in a matter of months, sometimes couple weeks actually. Just look at 2022 when Bitcoin crashed from $69,000 to $16,000. Okay, that's a massive crash. Companies with high exposure, especially those that leverage debt to buy in, could face serious balance sheet pressure. MicroStrategy, for example, carries $4.6 billion in convertible notes, much of which was used to fund its Bitcoin strategy. As long as Bitcoin remains elevated, that looks smart. But in a downturn, that kind of leverage becomes very much a liability. And this is not just theoretical, right, guys? Tesla famously sold 75% of its Bitcoin holdings in 2022, citing liquidity concerns. They weren't alone. As of July 2025, nearly half of corporate adopters have an average entry price above $90,000, which means it wouldn't take much of a pullback to wipe out billions of unrealized gains. Bitcoin's correlation with broader risk assets also matter. When markets sell off, Bitcoin tends to go with them, which limits its usefulness as a hedge, especially when companies need liquidity the most. Second, custodial and cybersecurity risks are still underappreciated. Most corporate holders aren't storing Bitcoin themselves. They're using third-party custodians. Coinbase Custody, for instance, manages around 30% of institutional Bitcoin, with other big players like BitGo and Fidelity also in the mix. That centralization creates risk, all right? If a major custodian suffers a hack, data breach, or operational failure, the impact could be just massive. Think about how exposed the ecosystem becomes when the same handful of custodians are responsible for tens of $billions in Bitcoin. On the flip side, self-custody isn't simple either. Losing private keys means losing access forever. And while crypto native firms might understand that risk, many traditional companies absolutely do not understand that. Okay, so historically, around 20% of all Bitcoin is estimated to be lost, often due to user error. Third, regulatory risk is always looming. The current political climate in the United States is unusually pro-crypto. We got the Strategic Bitcoin Reserve, we got spot ETFs, and we've got a regulatory framework that, while still messy, is at least moving forward, okay? But that can change very fast. The 2029 election is already on the radar for Bitcoin holders. A different administration could easily reverse the course, reclassify Bitcoin holdings, impose punitive taxes on unrealized capital gains, or even order the liquidation of government reserves. That should not surprise anyone here, all right? Internationally, the picture is even more fragmented. China's ban is still in effect. The EU is navigating MiCA, and emerging markets remain largely unregulated, which is kind of nice. The SEC's past actions against Coinbase and Binance, including lawsuits, fines, and delisting threats, shows that even in the US regulatory comfort can vanish overnight. Okay, fourth, Bitcoin's ESG footprint remains a reputational risk. I couldn't care less because it's better than the US dollar. But Bitcoin's mining consumes around 150 terawatt hours of electricity annually, according to the latest Cambridge data. That's more than some countries. For companies with strong ESG mandates, which includes about 60% of S&P 500 firms, this can be a deal breaker. Tesla, for example, faced heavy backlash in 2021 over its Bitcoin holdings and eventually walked them back, citing environmental concerns. Just totally forgetting how the US dollar works. But even with improvements in renewable energy use and mining efficiency, the narrative persists. And for the reputation sensitive sectors like finance, retail, or consumer tech, it's a real obstacle, guys. Finally, there's the risk of corporate sell-offs triggering market declines. That is definitely going to happen this next bear market. Okay, but imagine this. Bitcoin enters a bear market. The price falls about 30%, and several companies that bought Bitcoin for PR purposes decide to cut losses and exit. This kind of coordinated selling, say 100,000 to 150,000 Bitcoin, could depress prices another 15 to 25%, according to order book depth on daily exchange volumes. Okay, so we've seen this play out before. When Tesla offloaded 10,000 Bitcoin in 2022, Bitcoin dropped roughly 10% over several weeks. Now multiply dozens of companies holding much larger sums. And it's not just size, it's about conviction. Firms like MicroStrategy or Block are likely to hold through volatility. But companies like GameStop or Rumble, who have added Bitcoin in 2025 with smaller allocations and a marketing slant, may not have the same staying power. This creates a risk not just to the price, but for Bitcoin's public perception. If corporate holders are seen as fair weather allies, their actions could erode trust during critical moments. As you can see, the risk of corporate Bitcoin reserves are very real, but that doesn't mean the trend should be dismissed, okay? It means we need to understand who's buying, why they're buying, and how prepared they are to weather a storm. The serious players tend to fall into four different categories. 1, tech-forward firms like MicroStrategy and Block. Number 2, crypto-native companies like Mara Holdings and Coinbase, already deeply embedded in the crypto ecosystem. For them, holding Bitcoin is both symbolic and operationally logical. Mara, for example, holds 50,000 Bitcoin as part of its broader mining and infrastructure strategy. Number 3, small to mid-sized companies with high risk tolerance like Fathom Holdings and Semler Scientific, looking to hedge inflation, attract attention, or explore crypto treasury diversification. Their allocations tend to be smaller, but in some cases they represent a significant portion of the company's total assets. And 4, firms based in inflation-prone regions. Mercado Libre in Argentina is a great example. With local currencies collapsing, Bitcoin becomes a way to preserve value amidst chaos. But then there's the 5th category, marketing-driven adopters. These are companies like GameStop, Rumble, LQR House, and Thumbs Up Media, who announced Bitcoin purchases in 2025 with a lot of noise, but relatively small allocations. For them, Bitcoin is often more of a branding tool than a core treasury strategy. That's not necessarily a bad thing. Any demand can help support price, but these are the companies most likely to panic sell or abandon their strategy when the market turns. As crypto enthusiasts, we need to be able to spot the differences here. So how should we, as believers in Bitcoin's long-term value, approach this trend? The key is to balance optimism with caution. There's plenty of good news here. Corporate adoption increases Bitcoin's legitimacy, it deepens liquidity, it puts Bitcoin on the radar of institutional allocators, asset managers, and even governments. The post-halving supply squeeze combined with ETF inflows, 43 billion in Q1 2025, and the creation of the US Strategic Bitcoin Reserve all signal structural demand that wasn't here just a few years ago. But let's not pretend there are no risks, guys. Okay, so as a high concentration of Bitcoin with a handful of companies, especially those using centralized custodians, creates a single point of failure. Regulatory risk has not gone away, all right? And we've seen what happens when hype-driven players are forced to unwind positions during downturns, which we are definitely going to have in the future. The best thing crypto users can do is stay informed. Know who's holding what, watch how those companies talk about their strategies, and also, are they in it for the long run or are they chasing headlines? Most are chasing headlines right now. And here's a quick snapshot to help you get your bearings. As of 2025, approximately 134 to 145 companies are holding Bitcoin on their balance sheets. Altogether, they control around 855,000 Bitcoin, nearly 4% of the total supply. MicroStrategy remains the largest corporate holder by far with 597,000 Bitcoin alone. Other significant holders include Mara Holdings with 50,000 Bitcoin, Block with 8,000 Bitcoin, Tesla with 11,500 Bitcoin, and both Hut8 and Coinbase each holding around 9,000 Bitcoin. Metaplanet has accumulated 4,500 Bitcoin, while Semler Scientific holds 1,273 Bitcoin. These figures are sourced from Bitcoin treasuries, CoinGecko, and recent Standard Chartered reports from June and July 2025. So what is the verdict here? The rise of corporate Bitcoin reserves is undeniably a powerful vote of confidence in Bitcoin's legitimacy. It's fueling demand, strengthening liquidity, and slowly pushing Bitcoin deeper into the mainstream financial system. But with that comes a shift in dynamic, one that isn't entirely risk-free. Volatility, custodial centralization, ESG scrutiny, and regulatory uncertainty all remains very real threats. Not to mention the possibility of panic-driven sell-offs from companies that were more interested in headlines than long-term conviction. Crypto enthusiasts should absolutely recognize the upside here, but we should also stay sharp. Celebrate companies that show real commitment, but don't blindly trust every brand that throws Bitcoin into a press release. Stay informed, track corporate wallets, watch for shifts in regulatory tone, especially after the next US administration in 2029. And most importantly here, stay true to the ethos of the space: transparency, decentralization, and resilience. If you found this breakdown helpful, you'll find even more deep dives like this over at learningcrypto.com, where crypto education goes way beyond the hype.